You would agree that venturing into a new industry, one has to be familiar with the common terminologies used in that niche. But have you ever watched a trading video and felt they were speaking a completely different language? Terms like pips, liquidity, arbitrage, shorting. It sounds incredibly complicated, right? And honestly, that gate keeps a lot of people from building wealth. Welcome back to Analytics Hub channel. Today, I'll be diving into the ultimate financial market dictionary. I have compiled the most important terms across Forex, crypto, and the stock market. By the end of this video, you are going to understand exactly what the pros are saying and you'll be ready to navigate the market with complete confidence. Let's get into it. Starting with the general market concept, we have terms like bullish and bearish. Bullish and bearish signifies the overall market direction. That is, either price is going up or price is going down. Bullish means you expect the market or asset price to go up, and bearish means you expect it to go down. These terms reflect investor sentiment about the market and the economic trends. The term bullish describes a positive outlook when the market is trending up, and the bearish describes a negative outlook when the market is trending down. Portfolio is a collection of financial investments. It includes your crypto, stocks, cash, and any other assets you own. These are mostly stored in a wallet, and we have two types of wallet. They are cold wallet and hot wallet. Equity is the true value of what you own after subtracting any debt or liabilities attached to it. It represents your actual ownership in an asset. For example, if your trading balance is $1,000 but your floating profits are $200, then your equity is the sum of your balance and your unrealized profit, which is now a total of $1,200. Liquidity is how easily an asset can be bought or sold without affecting its price. Cash is the most liquid asset in the world. Literally, liquidity is money. Without liquidity, price will be static, and liquidity is the fuel of price action. ROI, return on investment. This is the ultimate metric for profitability. It measures exactly how much money you made or lost on a trade compared to what you originally put in. It's usually calculated or measured in percentage, e.g. plus 150%, minus 30%, etc. Appreciation and depreciation. Appreciation is when an asset's value increases over time, while depreciation is when an asset loses value over time. These are another term to indicate bullish and bearish or uptrend and downtrend. Dip is a temporary short-term drop in the price of an asset. This is often seen by traders as a discounted opportunity to buy. Let me show you an example of the recent dip that occurred in BTC USDT. After peaking at an all-time high of around 126 grand in October 2025, BTC has been in a significant pullback since then. And from this price action, you can see BTC has peaked an all-time high of $126,113.6, and let's say an all-time low of around $5,993.9 based on this monthly time frame price action. So all-time low, that's what I just said, is the absolute lowest price an asset has ever reached in its entire trading history, while all-time high is the absolute highest price an asset has ever reached in its entire trading history. Arbitrage is the buying of an asset in one market and instantly selling it in another to make a profit from a slight difference in price. An example is when you go to a website known as CoinMarketCap. You can see this particular crypto coin called Chainlink. It is selling at a price of 8.71 on Binance Exchange. It is selling for 8.75 on an exchange called Upbit. So if you want to make money from the difference in price, you have to buy from Binance and you sell on Upbit. But we should also consider factors like volume, transfer fees, trading fees, because they often eat into these tiny margins. Volatility. This is how fast and how aggressively prices are swinging up and down. High volatility means wide price movement, while low volatility means the market is quiet. Inflation is the rate at which the general cost of living rises, which slowly eats away at the purchasing power of your money. Inflation simply means that your money buy less today than it did yesterday. Buy less today than it did yesterday. Yeah. So moving on, we have terminologies under entering the market. Terms like long and short. Long means you are buying with the expectation the price will rise, while short means you are selling borrowed assets with the expectation the price will fall. So while trading market like forex or futures, we can actually go long or we can go short. Quote. Quote is the last price at which an asset traded. A quote provides two prices, the bid and the ask price. This is practically how a broker or exchange presents an exchange rate so that you can actually place a trade. Bid and ask price. The bid price is the highest price a buyer is willing to pay for a security or asset, while the ask price is the lowest price that a seller is willing to accept. Typically, the bid price is lower than the ask price. Let me show you an example on a broker. Yeah. So for this currency pair SAU-USD, that is good. When I click on the buy, you can see the highlight ask price. It is 4,675.79. When I click on the sell, I have the highlight as 4,675.49. So the golden rule to remember is that every time you click on buy, whether you open a long or you close a short, you pay the ask price, and every time you click sell, you get the bid price. Spread is the tiny price gap between what a buyer is willing to pay, which is the bid, and the lowest price the seller will accept, that's the ask price. So brokers often make their money on this gap. Execution is the exact moment your buy or sell order is successfully completed and filled by your broker or exchange. Slippage is when the trade is executed at a slightly different price than you expected. This usually happens when the market is moving incredibly fast. This happens for one of the two main reasons: high volatility and low liquidity. For high volatility, the market is moving too fast. That is, for example, during major news events like an inflation report release, prices can jump widely in milliseconds. When you click buy or sell, your order is sent to the broker servers, but even if the transmission takes just half a second, in a highly volatile market, the original price you saw is already gone. The broker then fills your order at the next available price, which might be significantly higher or lower. And for low liquidity, this simply means not enough buyers or sellers are available in that current market. Market order is an instruction to buy or sell an asset immediately at the best available current price. Limit order is an instruction to buy or sell an asset only if it reaches a specific better price that you have set in advance. Open order is a trade instruction you have placed in the system that has not been executed yet because your target price hasn't been hit. So basically, when you set a limit order, you have an open order until price gets to that your entry level before it gets executed. Take profit is an automatic order to close your trade once it hits a specific profit target, that is locking in your money before the market reverses. Moving on, stop loss is an automatic order to close your trade if the price moves against you. This is your ultimate safety net to prevent blowing your account. Let me show you an example on a particular pair. So on this price chart now, when I click on this long 2, I can highlight 3 significant prices. This one that is shaded in gray color, that is 109.449. that is the stop loss price. This one that is highlighted in dark black, that is 109.590, that is the entry price. And this one in green color, 110.264, that is the take profit price. Stop entry order. We have two types of stop entry order. We have the buy stops and we have the sell stops. So the buy stops is an order placed to buy above current price, while the sell stops is an order placed to sell below current price. This is like an opposite of the limit order. So traders use this to cash a strong momentum. Volume is the total amount of an asset being traded during a specific time. High volume means a lot of money and interest are flowing into that asset. So moving on to the terminologies under reading the chart, we have TradingView. This is the industry standard app and website where traders look at price charts, draw lines and analyze the market before placing a trade. Candlesticks, the visual blocks on the chart, usually green and red in color, that show you exactly how high and how low a price moved during a specific time frame. I have an example draft out of my chart. So I have my bearish candle in red color and my bullish candle in green color. So how do you differentiate between a bearish candle and a bullish candle irrespective of your color preference? Basically, the bullish candle has their closing price above the opening price, while the bearish candle has their closing price below the opening price. Using this particular candle here that was printed on March 2, 2026 as an example, it opened at a price of 1.1863 and it went as low as this. This tiny line here is called the candle shadow or wick, and this rectangular box here is called the candle body. So it went as low as that and went as high as this price called 1.1941 and finally closed at a price of 1.1939. Lower low and lower high. It is a stair-step pattern on a chart showing that sellers are in control. It is the classic visual signature of a market in a downtrend or bearish market. So I have an example for that too. Okay, using this particular price action on my screen as an example, I can say that price was at this high, then it fell below to this point. So price gave us this low and now it retraces to give us another high, but this particular high is lower than the previous high. So this is what a lower high. Then price fell down, like drop a bit again to give us another low, which is now lower than the previous low. So this is what a lower low. Now this is another lower high and this is a what, a lower low. This is just a classic representation of price in downtrend. Then for higher high and higher low, is a stair-step pattern in a chart showing that buyers are also in control. So let me show you an example of that. So using this one as an example, we'll see that okay, price was at this low before, it gave us this high. Now price from this particular high, price retraces a bit to give us this low, but this low didn't go below this one, so it is a higher low. It is higher than the previous low. Now this higher low give us another high, which is higher than the previous high. Now this one also give us another low. This is now another higher low, higher high, higher low, higher high, higher low, higher high, and so on. So this is just what a visual representation of an uptrend. Support and resistance. A support is a price level that an asset struggles to break below, while a resistance is a price level that an asset struggles to break above. I have an example for that too. What is it? Okay, so if you notice, this one I marked out is called what, a resistance. You notice that this rectangular box here, or this particular price level, price has not been able to break above it, so it is called a resistance. And this one here is called a support. You can see that price has just been bouncing off that particular zone. It is called a support because price has been unable to break below it. Demand and supply, the fundamental forces that drive all market prices. Every demand from buyers pushes prices up, while every supply from sellers pushes prices down. Point of interest, a specific high probability area on your chart, such as a major key level or order block. where you patiently wait for the price to react before executing a trade. The time order block is usually defined as the last opposite colored candle before a strong impulsive move that breaks market structure. For example, in an option, when price is creating new higher high, it is breaking the previous high to give us a new high. That is what a break of structure. Indicators. These are mathematical tools and overlays like the RSI or the MACD. So RSI means relative strength index and MACD means moving average convergence divergence. Added to your chart, they use past price data to help you predict future market moves. So break of structure, BOS. When the price clearly pushes past a previous major high or low, confirming that the current trade is strong and continuing, that is what a break of structure. And change of character is the very first early warning sign that the trend might be reversing. It happens when the price breaks a minor level in the opposite direction of the main trend. Just like in an uptrend, when price finally break below the higher low that was created, now it is what that first break is called what a change of character. Inducement. This is a technical term. It is a short-term trap set by the market to trick impatient traders into entering a position too early, creating liquidity just before the real move happens. You understand this more in the technical playlist. Imbalance example is a what fair value gap FVG. A sudden aggressive price move that leaves a visible gap between candlestick wicks. It shows an area where only buyers or only sellers were in control, and the market often returns later to fill this gap. So, and that wraps up part 1 of our ultimate financial market dictionary. I've laid down the core foundations, but we are only halfway there. Before you go, drop a comment and let me know which of these terms finally clicked for you. If this video helped you out, subscribe and engage on the channel. Keep putting in the work, and I'll see you in the next one.